Top 25 Financial Analyst Interview Questions and Answers. In this video, we will explore the top 25 financial analyst interview questions commonly asked by employers. Understanding these questions can significantly enhance your preparation and boost your confidence during the interview process. We will also provide insightful answers and tips to help you articulate your thoughts effectively. This resource aims to equip you with the knowledge needed to impress potential employers and secure your desired position. 1. How do you analyze financial statements? What key ratios do you focus on? Analyzing financial statements involves reviewing the balance sheet, income statement, and cash flow statement to gauge a company's financial health. Key ratios to focus on include the current ratio to assess liquidity, the debt-to-equity ratio for financial leverage, and the return on equity, ROE, for profitability. Other important metrics are gross margin and operating margin, which indicate operational efficiency. Trend analysis over multiple periods helps identify patterns and anomalies. Each ratio tells a part of the company's story, enabling informed decision-making based on comprehensive data evaluation. 2. Walk me through a discounted cash flow, DCF, model. How do you determine the discount rate? A discounted cash flow, DCF, model estimates the value of an investment based on its expected future cash flows. First, project the company's free cash flows for a certain number of years, typically 5 to 10. Then, calculate the terminal value, which accounts for cash flows beyond the projection period. The next step involves discounting these cash flows and terminal value back to present value using a discount rate. The discount rate often reflects the company's weighted average cost of capital, WACC, which incorporates the cost of equity and debt. This rate considers the risk associated with the investment and market conditions. 3. How do you assess a company's liquidity and solvency? Assessing a company's liquidity involves analyzing its ability to meet short-term obligations. Key metrics include the current ratio and quick ratio, which compare current assets to current liabilities. A ratio above 1 typically indicates good liquidity. For solvency, focus on long-term financial stability by evaluating debt-to-equity and interest coverage ratios. A lower debt-to-equity ratio suggests less reliance on debt, while a higher interest coverage ratio indicates better capacity to meet interest obligations. Reviewing cash flow statements also helps understand cash generation capabilities for both liquidity and solvency assessments. 4. Explain the difference between EBITDA, net income, and free cash flow. EBITDA, earnings before interest, taxes, depreciation, and amortization, is a measure of a company's operational performance, focusing on earnings generated from core business activities. Net income represents the profit after all expenses, including interest and taxes, have been deducted. Free cash flow, on the other hand, indicates the cash generated after capital expenditures, reflecting the liquidity available for distribution to investors. Each metric provides unique insights into a company's financial health, with EBITDA focusing on profitability, net income highlighting overall profit, and free cash flow demonstrating cash availability for growth or dividends. 5. How would you forecast revenue for a company in a volatile industry? To forecast revenue in a volatile industry, begin by analyzing historical sales data to identify trends and patterns. Utilize multiple forecasting methods, such as time series analysis, moving averages, and regression analysis, to account for fluctuations. Incorporate market research to understand customer behavior and industry changes. Collaborate with sales and marketing teams to gather insights on upcoming product launches or promotions. Lastly, create different scenarios, best case, worst case, and most likely, to gauge potential outcomes, adjusting forecasts regularly based on new data and insights. 6. What financial modeling techniques have you used in previous roles? In my previous roles, I have utilized various financial modeling techniques including discounted cash flow, DCF, analysis, scenario analysis, and sensitivity analysis. DCF models helped in valuing companies by forecasting cash flows and determining appropriate discount rates. Scenario analysis allowed me to assess potential outcomes based on different assumptions, which is crucial in volatile markets. Sensitivity analysis enabled me to evaluate how changes in key assumptions impact financial metrics, ensuring robust decision-making. Each technique has been essential for conducting thorough financial evaluations and supporting strategic planning. 7. How do you evaluate investment opportunities? What metrics do you prioritize? Evaluating investment opportunities involves analyzing potential returns relative to associated risks. Key metrics include internal rate of return, IRR, net present value, NPV, and payback period. IRR helps assess the profitability of an investment, while NPV considers the time value of money to determine if an investment will add value to the firm. The payback period indicates how quickly an investment can recoup its costs. Additionally, I look at market trends, competitive positioning, and qualitative factors such as management quality and industry dynamics to make informed decisions. 8. What is working capital, and how do you optimize it? Working capital refers to the difference between a company's current assets and current liabilities. It measures a company's short-term liquidity position and its ability to cover its short-term obligations. To optimize working capital, businesses can implement strategies such as improving inventory management, streamlining accounts receivable processes, and negotiating better payment terms with suppliers. Regularly monitoring cash flow and maintaining a balance between current assets and liabilities helps ensure that funds are available for day-to-day operations while minimizing excess cash tied up in non-productive assets. 9. How do you perform variance analysis? Can you give an example? Variance analysis involves comparing planned financial performance against actual results to identify discrepancies. For example, if a company budgeted $100,000 for marketing expenses but spent $120,000, the variance is $20,000 unfavorable. To perform this analysis, one calculates the variance for revenue and expenses, categorizing them into favorable or unfavorable based on whether actual figures exceed or fall short of budgeted amounts. This analysis helps in understanding areas where the company is overspending or underperforming, thus guiding management decisions on resource allocation and strategic adjustments. 10. Explain how you would assess the financial health of a company using ratio analysis. To assess a company's financial health using ratio analysis, I would focus on several key ratios. First, I would examine liquidity ratios, such as the current ratio and quick ratio, to evaluate short-term financial stability. Next, I would analyze profitability ratios like the gross margin, operating margin, and return on equity to understand the company's ability to generate profits. Additionally, I would look at leverage ratios, including the debt-to-equity ratio, to assess financial risk. Lastly, I would review efficiency ratios, such as inventory turnover and asset turnover, to gauge operational effectiveness. 11. Describe a time when your financial analysis led to a significant business decision. In my previous role, I conducted a financial analysis that revealed a consistent decline in our product line's profit margins. By diving deep into cost structures and sales data, I identified inefficiencies in our supply chain and pricing strategy. I presented my findings to management along with a proposed restructuring plan, which included renegotiating supplier contracts and adjusting pricing. This led to a 15% increase in profit margins within 6 months, significantly impacting the company's bottom line and enhancing our competitive positioning in the market. 12. How do you handle tight deadlines when preparing financial reports? Handling tight deadlines requires effective time management and prioritization. I start by breaking down the reporting process into smaller tasks, identifying critical components that need immediate attention. Communication with team members is essential, ensuring everyone is aligned and aware of their responsibilities. Utilizing templates and automation tools can streamline data collection and reporting. I also remain flexible, adjusting priorities as necessary, while maintaining the quality and accuracy of the financial information presented. Staying focused and organized is key to meeting deadlines without compromising on thoroughness. 13. Tell me about a time you identified an error in a financial model. How did you correct it? In a previous role, I discovered a significant error in a financial model while preparing quarterly forecasts. The model had an incorrect formula in the revenue projection section, which led to inflated revenue estimates. I took immediate action by auditing the entire model to ensure accuracy. After pinpointing the error, I corrected the formula and recalibrated the forecasts. I then presented the revised model to my team, explaining the impact of the correction on our forecasts. This experience reinforced the importance of meticulous review and clear communication in financial analysis. 14. How do you present complex financial data to non-finance stakeholders? When presenting complex financial data, clarity and simplicity are key. Start by understanding your audience's background and tailor your presentation accordingly. Use visuals, such as charts and graphs, to illustrate trends and relationships, making the information more digestible. Avoid jargon and explain concepts in layman's terms. Highlight key takeaways and their implications for the stakeholders. Engage the audience by inviting questions, ensuring they feel comfortable discussing the data. This approach not only improves understanding but also fosters collaboration and informed decision-making. 15. Describe a situation where you had to persuade management based on your financial analysis. In one instance, I conducted a detailed analysis of a potential investment opportunity that seemed promising at first glance. My financial modeling indicated that while the projected revenue was high, the associated risks and costs were significantly underestimated. I prepared a comprehensive presentation highlighting my findings, including alternative scenarios and sensitivity analyses. By illustrating potential pitfalls and their financial implications, I was able to persuade management to reconsider the investment. This led to a more cautious approach, ultimately saving the company from significant losses. 16. What key economic indicators do you monitor, and why? Key economic indicators to monitor include GDP growth rates, unemployment rates, inflation rates, consumer confidence indices, and interest rates. GDP growth rates provide insights into economic expansion or contraction, while unemployment rates indicate labor market health. Inflation rates help assess purchasing power and cost pressures. Consumer confidence indices reflect consumer sentiment, influencing spending behavior. Lastly, interest rates impact borrowing costs and investment decisions. Monitoring these indicators allows for informed financial analysis and strategic planning, enabling better forecasting and risk management in various economic environments. 17. How do changes in interest rates impact financial forecasting? Changes in interest rates can significantly affect financial forecasting by influencing borrowing costs, consumer spending, and investment decisions. When interest rates rise, the cost of borrowing increases, which may lead businesses and consumers to reduce spending. This can slow down revenue growth projections. Conversely, lower interest rates tend to encourage borrowing and spending, potentially leading to higher revenue forecasts. Additionally, interest rates can affect discount rates used in valuation models, impacting the present value of future cash flows. Thus, accurate forecasting requires careful consideration of interest rate trends and their potential effects on various financial metrics. 18. What industry trends are currently affecting financial analysis? Current industry trends affecting financial analysis include the increasing reliance on technology for data analytics and modeling, emphasizing the importance of real-time data in decision-making. Sustainability and ESG, environmental, social, governance, factors are becoming crucial, as stakeholders demand transparency and accountability. Additionally, remote work and digital transformation are changing financial reporting dynamics, requiring adaptability in financial practices. Market volatility, influenced by geopolitical factors and economic shifts, also necessitates a more agile approach to forecasting and risk assessment, impacting how financial analysts interpret data and make recommendations. 19. How do you stay updated on accounting standards, for example, GAAP, IFRS? Staying updated on accounting standards involves several strategies. Regularly reading publications from authoritative sources such as the Financial Accounting Standards Board, FASB, and the International Accounting Standards Board, IASB, is crucial. Attending webinars and conferences focused on accounting updates helps in gaining insights. Participating in professional accounting organizations provides access to resources and networking opportunities with peers. Engaging in continuous education through courses or certifications ensures familiarity with changes and their implications on financial reporting practices. 20. How would you assess the risk of investing in a new market? Assessing the risk of investing in a new market involves several key steps. First, conduct thorough market research to understand the local economic environment, including political stability, regulatory framework, and cultural factors. Analyze competitors and their market share, as well as potential barriers to entry. Financial metrics such as currency risk and inflation rates should be evaluated to gauge economic volatility. Additionally, consider operational risks, including supply chain logistics and local labor conditions. Engaging with local experts or consultants can provide valuable insights, helping to mitigate potential investment risks effectively. 21. If you noticed a sudden drop in a company's gross margin, how would you investigate it? To investigate a sudden drop in a company's gross margin, I would first analyze the income statement for changes in revenue and cost of goods sold, COGS. I would look for any significant shifts in pricing, sales volume, or product mix that could affect margins. Additionally, I would investigate external factors such as market conditions, increased competition, or supply chain issues that might impact costs. Speaking to relevant departments, like sales and procurement, can provide insights into operational challenges or pricing strategies. Analyzing historical data and trends can help identify patterns contributing to the margin decline. 22. How would you value a company with inconsistent cash flows? Valuing a company with inconsistent cash flows requires a multifaceted approach. One method is to use a discounted cash flow, DCF, analysis, focusing on a range of future cash flow scenarios to account for variability. Additionally, applying valuation multiples from comparable companies can provide context, especially utilizing metrics like EBITDA or revenue. Another approach is using a real options valuation, which can capture the flexibility and strategic decisions a company might face. It's critical to assess the reasons behind cash flow inconsistencies for more accurate forecasting and valuation. 23. What steps would you take if your financial projections were significantly off from actual results? If my financial projections were significantly off from actual results, I would begin by conducting a thorough variance analysis to identify discrepancies. This involves comparing projected figures against actual outcomes and recognizing the primary drivers behind any variances. Next, I would review the assumptions made during forecasting to ensure they were realistic and grounded in current market conditions. Engaging with relevant stakeholders to gather insights on unexpected factors affecting performance is crucial. Lastly, I would revise the financial model as needed, incorporating new data, and communicate the updated projections clearly to ensure alignment across the organization. 24. How do you prioritize multiple financial analysis tasks with competing deadlines? When faced with multiple financial analysis tasks and competing deadlines, I start by assessing the urgency and importance of each task. I prioritize based on factors such as the impact on stakeholders, alignment with strategic goals, and the time required for completion. I use a project management tool to allocate resources effectively and set clear timelines. Communicating with team members helps ensure that everyone is aligned, and I remain flexible to adjust priorities as needed. Regular check-ins allow me to monitor progress and reallocate efforts where necessary. 25. If you had limited data for a financial model, how would you proceed? When faced with limited data for a financial model, I would first identify the key drivers necessary for the analysis. I would gather any available historical data and industry benchmarks to fill gaps. Collaborating with cross-functional teams can provide additional insights or qualitative data that may be useful. Sensitivity analysis can help understand how changes in assumptions impact outcomes. Additionally, I would clearly document any assumptions made and consider using a range of scenarios to account for uncertainty. Engaging stakeholders early on ensures alignment and sets realistic expectations. As you prepare for your financial analyst interviews, familiarizing yourself with these top 25 questions can significantly enhance your chances of success. Understanding the core concepts and practicing your responses will allow you to convey your expertise confidently. Remember, each interview is an opportunity to showcase your skills and knowledge in the finance field. If you found this video helpful, please give it a thumbs up and subscribe for more valuable content to help you excel in your career. Thank you for watching, and best of luck in your interview journey.